we are a super long-term fund. We are a fund for future generations. We may be here for the next couple of 100 years. In the US, you have more of the ESG backlash. ESG is more politicized, and because of that, maybe it's a little bit more room for a US corporate to be less ambitious and forward-leaning when it comes to setting emission reduction targets. First of all, let me say, we are the world's most transparent fund because we are actually number one on the list of that. In general, as I said, we don't want to sell out of companies. We want to change companies where we see material risk in some sort of way. The more data we can have is good. So we buy data.
Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
In this interview, Hugh Van Steenis and I talked to the Chief Governance and Compliance Officer at Norges Bank Investment Management. Carine is likely the most powerful person in the world of ESG, given that Norges is the world's largest equities owner. Not that you would know it, because she's terribly nice with a permanent smile and a disarming manner. Underneath, I suspect she's quite tough, but she presents such polished arguments and is so reasonable that I suspect chief executives find it hard to resist her suggestions. We discuss a wide range of topics: how you can combine sustainability with the pursuit of returns, the difference between the US and Europe when it comes to the energy transition, how Norges takes action to divest and exclude companies from the fund on climate, environmental, and even tax grounds, how they conduct their ESG reviews, issues with ratings of ESG and how they can be improved, and why companies pushing back their climate targets paradoxically may actually be a sign of progress. Carine is uniquely placed to comment on the energy transition and all things relating to governance. My thanks to Hugh, who organised this and knows Carine well because he sits on the fund's Climate Advisory Board. This really is a fascinating conversation. I'm sure you're going to enjoy it. So Carine, welcome to the podcast. I'm really excited to talk to you. I've really been looking forward to this. And normally when I do these interviews, I normally ask people, did you always want to be an investor? And I know you couldn't have dreamed of being the Chief Governance and Compliance Officer at Norges Bank Investment Management, but you trained as a lawyer, I think. And is that what you wanted to be? And how did you end up in your current role?
Well, first of all, Steve, very nice to be here and chat with you. And you're absolutely right. I didn't dream of being Chief Governance and Compliance Officer. I probably didn't have an idea what that meant. But yes, you're right. I trained as a lawyer, but I also took a degree in finance. And I think the reason I trained for a lawyer was I thought it could be useful for many things. I didn't really know what I wanted to do, but I was always interested in a bit of business and finance. I started out actually as a corporate lawyer doing M&A type of work. And then one thing led to another. We started to work in-house for corporates because I thought it's interesting to be more involved in the sort of business decisions and the sort of being more close to the business. And then after a while, I got a few board seats, and then I got interested in more sort of thinking along long-term sustainability. And suddenly this job came up, That time it had a different name. It was called Global Head of Ownership Strategies. I didn't even know what that meant when they contacted me, but then I realized it meant like it was following up how a big fund exercise its ownership in many companies. And I thought, wow, that sounds exciting. So then I got promoted to chief and a few other responsibilities, and here I am. And what's great about this job is it combines so many things I've been doing. I've been doing a bit of law, a bit of finance, been doing a bit of boards, thinking long, sustainability. So I really enjoy what I'm doing.
And I was wondering, it's a huge responsibility, isn't it? You're in charge of telling some of the world's biggest companies to up their game in climate change. Now, I know you've got lots of help and there's lots of processes, lots of procedures and everything else. But I just wondered, how does it feel to do this job? And how do you stop yourself being like the chief box ticker? It's a huge responsibility. I mean, how do you carry that responsibility?
It is a huge responsibility, but so are many other jobs. And I have a wonderful team, really a lot of smart, dedicated, ambitious people working with me to do this job and fulfill the responsibilities we have. And it's absolutely not a box ticking job. It's a job thinking about how we can improve the long term value creation in the companies we have invested in. And that's a lot more thinking around strategy, thinking about value creation, thinking long term. So, not at all box ticking.
So it's more than a job.
Well, it's a
Huge.
job that has a meaning for me. In many ways, it has a meaning for me because I like the actual work we do is interesting, but also because it's about generating returns to fund the Norwegian welfare state for future generation of Norwegian. I like that, and I also like it because it's about thinking about sustainability of in the end the planet, because it's we think about how what the companies do affect the planets over the long term, and also how that affects the profitability of the companies.
Carine, so a lot of investors started with thinking that sustainability was about a risk screen, but obviously, as you're saying, it obviously blends more into value creation. How do you weigh up the kind of the risk evaluation with the returns in the portfolio?
Yeah, and we think that it's both. Both, it's about risk mitigation, but also value creation. And I think where we coming from it, Hugh, is that really we are a super long-term fund. We are a fund for future generation. We may be here for the next couple of 100 years. And so how we think about it is then the value of the fund is very much dependent upon the long-term value of the companies. And we think the companies can only generate long-term values to really think about how sustainable their business model is. I mean, let's take climate. That you know that well, but if we look at the value of the fund on a sort of scenario basis to 2050, what's clear is that an orderly transition to net zero 2050 will really safeguard the value of the fund by any other way of transition. So in orderly transition, we may lose up to 2% of the fund due to climate risk. Any other way of other transition, we lose a lot more. And also climate risk, it's a systematic risk when you're a universal owner that may affect almost all asset classes. And so if we didn't think about that, we wouldn't do our job. So for us, it's both.
I was going to say you've recently moved to New York, and obviously there's as many ways to do sustainability as there are investing groups. What surprised you in moving to New York?
Well, first of all, it's fantastic to live in New York for a year. It's a lot of energy in the city, lots of interesting people to meet, and have a great team. I think what's very interesting for me is to see how Americans view Europeans, and coming from Europe. where we talk much more about stakeholder value, sustainability, whereas we coming to America, it's much more about shareholder value, capitalism, making money. And look at Europe. I feel slightly like Europe is has lack innovation, being a bit slow, too much regulations. Whereas maybe from looking, when you're in Europe, you don't really see it from that perspective. Of course, I'm simplifying it, but the sort of the drive to innovate, making money, I feel it's much more stronger here, and the openness to sort of talk about it.
But is that at the expense of the climate aspect?
Um, yes and no. I mean, when we look at our portfolio and how well the companies are preparing for a low carbon uh, economy, we see differences between Europe and the US. Many more companies in our portfolio that's based in Europe have set clear targets and have credible transition plans. Having said that, it's also amazing to see some of the innovation taking place in US-based companies, and really the forward leaning they are in thinking through the value chain and decarbonizing and investing in transition solutions, climate solutions. So it's a lot of innovation on that part taking place there in the US. So from a portfolio perspective, yes, Europe is ahead, but sort of on the innovation side, in really investing in technology solutions, or in climate solutions, I don't have exact numbers. I'm sure Hugh maybe is more updated on that than me, but it's impressive to see a lot what's happening in the corporates, in companies.
So I was expecting you to sort of say that you were sort of a bit worried that America wasn't taking all this as serious. The American corporate sector wasn't taking this as seriously. It wasn't as high up on the board agendas in the US as it was in Europe. Is that an unfair conclusion?
I think it varies. It's hard to say it's sort of US overall. What I see, maybe certain sectors, not as much. But and of course in the US, you have more of the ESG backlash. It's more ESG
Yeah.
is more politicized, and because of that, maybe it's a little bit more room for a US corporate to be less ambitious and forward leaning when it comes to setting emission reduction targets. But as I said, uh, what we see when we talk to companies, we have lots of company meetings and dialogue, is still in many, many companies, it's impressive what they do when it comes to innovation for emission reduction.
And it may be actually, and it's fascinating in the political environment we're in. It may be that a lot more is going on below the surface and maybe not being publicized. So actually, your meetings give you an information
I
edge
think
on that.
that's right, Hugh. That's right.
So, after you.
No, I was just going to say, so, we sort of think about investments. So you're the world's largest investor, national investor. The fund's got a mandate to maximize returns. It's a bit awkward for you to exclude lots of companies or industries or sectors. I know you don't want to be investing in companies producing weapons, one example, but we also know you want to be engaged rather than run away from the debate. Can you talk a bit about how you sort of resolve this tension between engagement and exclusion, and where's the balance? What tips a company from, yeah, we want to engage with it, or into the, well, actually we just don't want to own it?
Yeah. I think when you're a large investor like we are, allocation decisions are the most important decisions. And we 70% have a 70% allocation to listed companies. It makes us the world's largest single owner of listed companies. Um, so, and that is set by the parliament. We're a very democratic fund, and we get a mandate from the ministry. But when they gave us that mandate, the parliament also said, there are certain companies we don't want to make money from an ethical perspective. It's just not right that Norwegians should make money based on that. And we call them ethical guidelines. And they say companies based on a certain involved in certain products or certain conduct we should not make money from, and they should be excluded. And that's not financial consideration involved. It's just purely ethical. So you mentioned weapon companies. So we're not involved in companies that produce certain type of weapons. We have actually lost money from not being involved in that, and we report every year on how much we lost. Um, but as I said, ethical consideration that decided by the parliament and being followed up by an independent council on ethics. So that's not our decisions. What we can do as a fund is that we can still decide to divest from companies based on more financial considerations. And we do that. But our starting point is really that we want to be an owner. That's how we make money. And that's how we can influence the companies. As simple as that. So uh, when we decide to divest, it's because we just think the risk involved in being invested in this company on the longer term is we just think the sort of business model is risky from a sort of more sustainability perspective, that we decide, what, we don't think we can influence this company through being an owner, so we might as well just sell out. And we call those risk-based divestments, very different from the ethical exclusions. We do that to take down risk. And we probably divested from 500 companies plus since we started doing that. And the interesting thing with that is that we have made money on it. So we report every year on how much we have made from our risk-based divestments. And I think since we started with it, we made around $6 billion. So that's very different considerations. But that's sort of our last resort, because it's much better if we can be an investor, change company, and make money.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. So can you give us an example of the sort of, one where you've had a debate and the management have said, oh, we understand what you're saying, we hadn't thought of that, we're going to change our ways, or one where you've disagreed and divested? I don't know, you might not want to name the companies if it's not public information, but give us some examples of how it works in practice. Because I imagine when the phone goes and it's the secretary says to the CEO, Carine's on the phone, there's a bit of trembling,
I wish. Okay, so we don't give names of the companies where we do risk-based divestment. We give a reason for doing it, but we say it's a financial decision, investment decision, so we don't give names. But as an example, you have a company maybe that's involved in palm oil production. And with that, it's a lot of, they need to be also involved in heavy deforestation and they do that in a way that's obviously not sustainable, and that's sort of their business model. Everything, I can call them, doesn't matter, that's their business model. They're not going to change that if we start to engage with them. So then we say okay, we think it's too much risk involved, we're going to divest from that. We do that for, just as I said, that for smaller companies. And we do that sort of thinking about forward looking risk without necessarily having 100% correct information. So that's also why we don't give names of the companies, because we think, well, it's in the end, maybe we didn't have total information here. But when you have a portfolio of 9,000 companies, you have to sort of make decisions sometimes without, 100% clarity. On the larger,
Can I just
yeah,
ask you? Can I just ask you on that, because I've invested in palm oil quite extensively in the past, and well, there are some good palm oil producers. They're very attractive investments because when I went to visit the plantation, I there was a map and there was a big line running through the middle of the plantation. And I said, "What's that?" And the guy said, "Oh, that's a new motorway." And so, of course, it used to produce palm oil, and then they converted the land into service station. So it was a property company, very long-term property company that was giving you a very attractive yield in the meantime, and it was a high quality business. But when you go around talking to the palm oil companies and you say to them, "Is there any truth that you're engaged in deforestation of Indonesia or Borneo or wherever it is?" Oh no, that's not us. And I mean, how do you get round that? Because it's very difficult to get proper understanding of when people are engaged in malpractice like
yeah,
that.
first of all, it's not all companies involved in palm oil production that's bad.
No,
I
no,
just
no,
took
no,
that
no.
as an example. If they have a really unsustainable deforestation practices, but in general, what we do is, when we look at companies to follow up because of heightened risk in some way or the other, is that we screen our portfolio. We do that on a quarterly basis for various indicators. We do that according to different sustainability issues. We can do it on, for instance, on climate, on human rights. We do it on tax. We can do it on water management. And then we have certain criteria that together make us some sort of screen. And then we get some companies that being, let's say, red flagged. What we do then we start to look more into their practices. So it's first, running it through a screen based on some parameters that we have decided. And that brings up a lot of companies to look at, but then we start looking at them on a more individual basis. And for most of these companies, you know, maybe we decide to do nothing, that the risk is sort of manageable and it's we want to continue to be invested. Some companies we decide to follow up from an ownership perspective. We have meetings with them. We can start to vote against the boards if we think that's a good way of following up. We Or we can just give the information we sit on to our portfolio managers who take active position and say, hey, do you know this and this with the company? And they may then decide to go underweight, for instance, invest less in that company. And then, in few instances, we may decide, you know what, we think we should just sell out, divest from this company. But that's sort of last resort, and done when we have looked at all other alternatives.
And if I were a Norwegian voter, I might say, "Oh, I think you should publicize the name of these companies that you're selling out of." So the example of the palm oil company, where you had sufficient comfort that you were right, that they were engaged in unsustainable deforestation, shouldn't the public know about that? You're not BlackRock trying to make extra bit of money. You're trying to make money for the Norwegian state, but you're also trying to do good. And I was just trying to understand how those sort of balance out.
Yeah, and that's fair. And you're not the first one that I've asked about that. So I'll tell you what we say to that. First of all, let me say we are the world's most transparent fund because we are actually number one on the list of that. When it comes to the companies we exclude for ethical reasons, it's very clear why we exclude them, which companies they are, the reasoning behind it. The companies have a right to reply to the Council on Ethics when they ask for information. Everything is open, transparent. When we make these risk-based divestments, we do them in two ways. We can do them, we invest according to an index, although we're not an index-based fund, we index near-based because we can take active positions, quite a big active positions outside of the index. But when the index we follow changes, companies come into the index. We screen all those companies when they come into the index. But we have very little time from when the changes in the index are announced to when they actually come into the index. So we have a short window of time here. We screen them. Some flags may come up. We try to assess them as well as we can in the time window we have with the information we have, bearing in mind that there's lots of companies we're talking about. We feel when we decide to divest that we have less information than, for instance, it's the Council on Ethics have, because we don't have the same thorough process around it. We base it on, of course, we have all the information the company has reported. So if they reported more, we'll have more information. Um, and we feel this is a part of the investment decisions we're making. So it's two reasons. We think it's not fair for the company because we know that a lot of investors follow us when it comes to ethical exclusions. We don't think it's fair that they necessarily should follow us in risk-based investment because we have had less time to consider, less interaction with the companies. And finally, because it's financial decisions, that's the one type of decisions we're not transparent about really is our sort of investment, individual investment decisions.
Because last year you reviewed and screened 1,048 companies entering the benchmark, and 317 were considered high ESG risk. 263 were put on an internal monitoring list, while you decided to divest from or not invest in 54. Is that typical proportions? Like 5% of the companies coming in, you just say there's an issue and I don't want to touch that because I don't know enough. I mean, is that the way we should think about it? 5%?
I don't have the total number, but I think that's pretty typical. Maybe it sounds slightly more than average, or maybe that was a quarter where we felt there is more risk than normal. But yes, that's how you should think about it in the way that at least we're open about how many companies we looked at, how many there are issues with, and how many in the end we decide not to invest in. But I think that sounds slightly more than the average, and over time, although I don't have that figure just in my head now.
So, Carine, can I just you mentioned there's obviously a lot of innovation in terms of carbon tech, but also a lot of innovation in how you measure emissions and what matters. And I'm struck that you've recently updated your expectations away from scope 1 and 2 and 3 to material emissions. Why the change, and what's the implication for the portfolio?
We still have take a step back. You mentioned our expectations to companies when it comes to climate. So we have published clear expectations to the companies. It's part of our climate action plan that we actually updated these recently. And in those expectations, we still state specifically that companies need to have targets when it comes to scope 1, scope 2, and material scope 3 emissions. So that's very much still an expectations to the companies we have invested in. And it's sort of up to the companies to to say whether or not their scope 3 emissions are material or not, and explain if they don't think it is, explain why it isn't. So yes, scope 3 is very much still part of our expectations. And then, of course, we also now have clear and detailed expectations around, credible transition plans. So very much going, from targets to actions in what we ask from the companies.
I was wondering, when you sort of feel uncomfortable about a company and Nikolai thinks it's very cheap, how does that conversation go?
So, so in general, as I said, we don't want to sell out of companies. We want to change companies where we see material risk in some sort of way. So that discussion probably goes quite well in saying, okay, if there are issues here, let's see what we can do as an owner in this company. Let's contact the companies. Let's talk either through, the chair, board members, management, convey our concerns. Have a dialogue. That's where we start with companies. Have a dialogue with the companies and see if there's anything we can convey our concerns. They can come back and explain why they're doing what they're doing. And then we can, if we want to see changes, we can also try to convey that.
And I mean, do you ever have disagreements? I mean, are there ever situations where Nikolai said, "Well, that's is not really a threat, and it's so cheap," and I mean, there must be. Oh, there's always tensions in these sorts of situations because, on the one hand, you're both trying to make money in the long term, but there can be quite, quite a nuanced, quite a lot of difference, quite a lot of difference.
I
Well, I
think
mean,
in
how
an
do you?
organization, there's always tension and always disagreement and also healthy discussions, right? And I think you're absolutely right. Quite often, there are good discussions, not necessarily with Nikolai always, but between us that have a certain view on how companies should manage sustainability risk and opportunities, and portfolio managers who invest in these companies. There can be good discussion around what should we talk to the companies about, what's material for the company, what's the issues to raise. And I tell you, when we probably have the most discussions is happening just in this period we're in now, that's called the voting season. And that's where we have big discussions around, should we support the board, should we not support the board, should we vote yes or no for a shareholder resolution. And we have very engaged discussions around that. Absolutely. But that's good. It's good to have different opinions and good to sort of discuss and before you come to a conclusion.
So, Carine, talking about disagreement, you've been the vice chair of the investor advisory group for the international standards boards. How are we seeing more divergence or convergence between what investors think would be useful, and how do you see the standards are
Yeah,
evolving?
first of all, I must say it's fantastic what the International Sustainability Standards Board, that's a mouthful, that's why we call it ISSB, have been doing, because they really managed to develop a what we call a global baseline for the company sustainability reporting in a very short time. And there's been a lot of debate about what should companies report, what's good reporting, bad reporting, too much reporting, too little reporting around sustainability issues. And investors have in general asked for more. Companies think it's been too much, too many frameworks to report against. And so this, what ISSB is trying to do, is to make a global standard. That's excellent. That's perfect. So they're now trying to implement this standard they've developed in various jurisdictions. Investors I talk to, and that's almost 100% of them, are, very happy to have they want a global framework. It's great if companies can report, the same way, whether they're incorporated in Indonesia or in the US or in Denmark. Fantastic. So I think in the investor advisory group is generally investors that's supportive to this framework. But of course, there are still a lot of debate around how detailed their reporting should be. Is it too much reporting burden on companies? It's still somewhat fragmented with what's happening in the EU now and the US. But I feel within the investor group, at least there seems to be a lot of consensus around a global standard being great.
And I mean that whole sort of issue about data, Carine. I mean, how do you feel about that? You're obviously a very large institution. I'd be interested to know, how many people you've got in your area. But there's all sorts of data providers, and they all come up with different scores. And to the sort of average lay person, I mean, I think I'm a reasonable analyst, but confronted with this array of different data suggesting different conclusions is quite bewildering. I mean, how do you look at this, and how do you resolve that problem?
I agree, Steve. It's very confusing. I'm confused myself with all the different ESG ratings. Absolutely. And I think it's a big problem that there's so many different ratings, because I think people, you hear it's an ESG fund, you think it's doing some good, you invest in it, and you don't really know what it means to be a ESG fund, because it can be rated in so many different ways, whether a company is as an AAA or CCC. Um, it doesn't really necessarily means the company is going to, say, what should I say, develop some technology that will save the planet. But anyway, so it is confusing. How we go about it is that we think data to have the more data we can have is good. So we buy
Yep.
data from various data providers, all sorts of data providers. We think it's great to sit on data. We don't put much value on the ESG ratings, because what we do is to take the data we have and do our own evaluations. It doesn't mean we do internal ratings, but we do our own internal evaluation of the data. But because it's so many different ESG ratings, we actually even wrote a small piece on this not that long ago. We called it something around our view on ESG ratings, and our point was that the rating agency should be more open about their methodology and the rationale behind the rating, because some base their rating on financial materiality for the company when it comes to sustainability issues, whereas other base the rating on how the company impacts, their environment, etc. Uh, so it's all different methodology. So we said just be open about, why you rate, what's your motivation for rating, how you rate, and the data input you have. Then, it's much easier for people to sort of make their own evaluation of the rating. So that's sort of, but the data we're very grateful for that we get from many of the rating agencies.
And how many people do you have doing this?
Depend on what you mean by doing this. We have a team that does what we call ESG analytics, that just looks on sort of number crunching, 5 6 people. But then when you look at the whole ownership, what we call the active ownership department, that really do the totality of following up our ownership. Maybe around 30 people, plus minus.
Well, it's not that. I mean, it's a sizable, but it's not enormous. It's within the. Well, Hugh's laughing, but
No,
it's not hundreds of people. It's something that any very large institution could accommodate. Whether if you're running several $100 billion, you could afford to do that. Do you think the those big institutions? Do you think they're placing enough emphasis on this analysis
you're right. We not
in
that many
general?
people. I just say we are, as an organization, we are a low cost, quite a small organization in totality. And I tell you, 30 people, we are very busy now doing voting during vote season, because at the end of the vote season we would have voted on more than 100,000 resolutions. So so we are kept busy. But I don't want to sort of criticize what other big institutions are doing. They if they have enough or not. I mean, there's many other big asset managers that's doing a great job, and taking their management responsibilities seriously.
And do you see any difference? So you're sitting in New York. Do you see any difference sitting in New York in people's investors' attitudes in New York versus London versus Europe,
I think
continental
it's
Europe?
fair to say, on a general basis, although there can be, of course, very much individual differences, that the big institutional funds in Europe are maybe slightly more focused on sustainability, rather than in the US. But again, that's a very sort of generalized statement.
There's a lot of professional investors listen to this podcast. Um, I just wondered, is there one thing or something that they could do tomorrow when they go back to the office? Nobody listens to this in the office. They're in the gym or they're in their commute or whatever. What is it? What is there one thing tomorrow that they could do to help us get a cleaner, brighter, faster, more stable transition?
Yes, Steve, I don't think it is really one answer to that and one thing they can do. I think everybody need to find for themselves, what is they want to, where do they want to have an impact? What's important to them? Is it important to lower emissions? Maybe invest in some of the supply chain, innovative companies that can sort out some bottlenecks in the supply chain. Or is it important to think more about nature? Then it's other types of companies you should invest in. So I think we're finding out, where is it you want to have an impact, and then pick the best companies in that sphere.
And just one thing I was very struck from your report was that you had companies that didn't have net zero targets saw a 7% rise in their emissions between 2015 and 2023, and companies which had set a net zero target saw a 2% reduction in their emissions. What? So obviously, when companies publish targets, they do a lot better. No surprise. What can you do to push more companies to set targets?
I think that data is so interesting. So I'm very glad you picked up on that, Steve. It's really interesting to see just setting targets, even though those targets are quite far ahead, then companies do something about it. They start to manage their emissions and get it down. And just to say, these are companies that set what we call science-based targets, so sort of credible targets. And that means, again, as you say, you know just setting a target makes you sort of think about how you can manage your company to get there. And that's why we, for a long, well, not that long, but for quite a few years, have again and again said to companies, start with target setting. Where do you want to be in 2030? Where do you want to be in 2040 and 2050? Start with targets, then you make credible transition plans of how to get there. And it really, that the data you refer to really shows that it matters. Even if you, and that wasn't even companies that had transition plans, there were companies that just set targets. Just setting targets changes practices and have resulted in reduced emissions.
One thing I'm very struck by, Carine, is that some companies are now revising their targets. And in a way, you can view that as a positive, that they're getting even more gritty and realistic as they understand them. Or you could be pessimistic, saying they're stepping away. What's your perspective as you see the iterations?
Yeah, it's interesting that they do. And I think in many ways we try to look at it in a positive way. That yes, companies are realistic. It doesn't go as fast as they thought. And we very much appreciate that. It is hard to reduce your emissions for many companies. I mean, the whole energy systems in a way have to change, and it's not done overnight. So I think, what we want to do is understand why they're doing it. Is it because they're less ambitious, or is it just because they're more realistic, but still have that overall target, net zero 2050, trying to be aligned with the goals of the Paris Agreement. But so far, when we talk to companies, we sort of think it's more around more realism and not so much being less ambitious.
And this target setting, in the same report, the share of portfolio companies with net zero 2050 targets, Europe 49%, America 23%, Pacific 21%. Is that why you're in New York?
What's interesting with these numbers, they don't show the dynamics, or maybe if you read the report here before, the area where it has increased the most in 2023 actually was Asia Pacific, which is now still lowest, but still having the highest increase. So this is a dynamic field, and it hopefully will have an uptick all over. But it was a little bit, but yes, it's a little bit maybe. Well, I'm in New York. I'm in New York. Let's see, for three reasons. First of all, 50% of our equity investments are in the US markets. So it's something, so I wanted to be closer to those companies. And secondly, yes, to be a clear voice here and say, for us, how you manage the climate transition really matters, because we think it's matters for our long-term returns. And the third reason is really New York is a fun place to be, and it's also to have some representation of the leader group in our international offices. So
No, absolutely. Well, listen, it's been really fascinating, delightful talking to you. New York's probably a little bit colder than London, but thank you so much for taking the time. I don't, Hugh, do you have any final things you want to leave us with?
No, I thought that was terrific, and obviously I get the honour of speaking to Carine far more regularly. But I think it's been fantastic for you to share publicly your perspectives. I found it a really interesting conversation.
Yeah, and a massive thank you and congratulations to you as a group, because you're really leading from the front, and it's fantastic to watch. And thank you so much for taking the time.
Well, it was great to talk to you both, and of course we also had great people helping us in the work we do on not the least the climate, like you, who's on our climate advisory board. But thanks to both of you for taking the time to speak with me. And actually, sun is shining in New York for a change. Thanks.
Thank you.
Well, you can probably now understand why I said Carine is a force, and someone I think it would be hard to argue with. I think it's reassuring that Norges is taking such a forward stance on the transition and on governance, and that they've got someone like Carine at the helm of all that. I would encourage you, please, to read the show notes. They have some links to some of the Norges publications, and they've got some really helpful insights. You can read all of that on the website behindthebalancesheet.com/podcasts, and you can sign up for my newsletter, which goes with this mini-series, at beyondthebalancesheet.substack.com. Hugh and I are doing this show for fun. There's no commercial angle, there's no ads, there's no sponsors, no money. If you've enjoyed these shows, please do me a favor. Take 2 minutes, 1 minute, leave a review, or simply a 5-star rating on Apple Podcasts or on Spotify. That will really help. Thank you for listening.